I'm Charlotte McLeod with investingnews.com, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for being here. Great to have you.
Thanks for having me, Charlotte.
Really good to be catching up with you, especially during what I have heard has been a really busy week for you. You've been at the Dubai Precious Metals Conference. So I thought we could begin there. I've never been to that event. I imagine many of our viewers also have never had a chance to attend. I wondered if you could share any key takeaways, things that you were hearing on the show floor.
You know, it's a different world here versus in the West. And I keep saying that. Here, the jewelry market is, by and large, the investment market. You know, if you read any Western analyst of the gold market, they'll talk about electronics demand and investment demand and jewelry demand. And there's a certain amount that goes to Tiffany's where they'll sell you, 3.5 grams of gold for $17,000. But most of, what's sold for jewelry is sold to Indians and Arabs and Turks. And in these cultures, it's sold by weight, right? So you pick up a necklace and it says right on there, this is whatever X number of grams, 30 grams. And it's sold by the weight times the gold price plus what they call a making charge, which in Dubai is a very, very competitive market. That making charge would be, often 5% or less. So very little markup. These guys are working on very tight margins, but very high volumes. That is investment. Now, the buzz obviously is the gold price. Boy, has it ripped higher versus, a year ago. And you would think that's good and everybody's happy. But as there's so many things in our, government managed, centrally planned world, and a fiat currency with a central bank is central planning. I get into arguments with economists about that. Yes, it's central planning, period, full stop. Central planning turns something that could be win-win and turns it into win-lose. So the rising gold price is great for people who bought gold, who are thinking about selling it because they have a gain. But on the other side of the equation are, the industry, and they're getting whacked, by the forehand and the backhand. The forehand is they, typically finance their inventories with a loan. So, you borrow $1 million, you buy $1 million worth of gold, you stick that in your store. And if the gold price drops 10%, now you have a $900,000 asset versus $1 million liability. You're insolvent. So you have to hedge. So you borrow $1.25 million, buy $1 million worth of gold, and put $250,000 into a margin account where you're shorting, usually gold futures. And when the price rises, you get margin calls. And margin calls are very unpleasant, very unwelcome, because essentially you have to come up with more capital. And where are you gonna find all the extra money? So it causes them a great deal of stress. That's the forehand. The backhand is, salaries have not kept up with the gold price. It's not, people think of inflation as this uniform, okay, well, the currency is losing value, and therefore every price as measured in the currency is going up. That's not the case. The price of gold has gone up massively, but salaries have not. And so what it means is people buy less gold by weight. If they would have bought a 10-gram bracelet, now they're buying a 5-gram bracelet because they have the same amount of money, same amount of currency anyway, and you buy half as much gold as you did a year ago or 2 years ago. So, the jewelers are selling, there's other reasons why sales volumes have picked up because people are becoming more agitated about the currency. But so people are increasing their commitment to gold, but the amount of gold you can get for the same buck is going down. So the jewelers are getting whacked, both ways. So, there's increasing buzz about silver jewelry, which is not, especially in India, but, I think Turkey, in the Arab world, silver is not the first choice. But it's what you can afford when you don't get, there's an expression I heard, people in hell want ice cream, doesn't mean they get it. The average day laborer wants gold, doesn't mean he can get it. So, they turn to silver, and so the demand for silver has been way up. and that perhaps could explain the silver price action. Just one little random rant, if I may. When the gold price goes up, everybody has to have either a conspiracy theory or whatever. Oh, it's central banks that have driven it up. Okay, well, silver is going up even more than gold, obviously, in the recent go around. That's not central banks. Central banks aren't buying silver. So who is? Well, there's more investment / jewelry demand, whatever you want to call it, from people who just are priced out of gold, or you can't get enough gold to be interesting, but you can get a lot of silver. Right? So suppose you had $200. How much gold can you get for that $200? Well, 20 of an ounce, right? How much silver can you get? Well, heck of a lot more, 4 whole ounces, or a bit under 3.5 ounces now. So, they're turning to silver, and, we've had big demand in silver, obviously driving the price up. There was a backwardation in silver, the likes of which I've never seen in all the time I've been following the market in October, spiking the silver lease rate as London measures it, causing all kinds of dislocations in the market. And so, conference like Dubai Precious Metals Conference, it's not investors saying, happy, joy, because gold and silver beat Bitcoin this year. It's the trade saying this is causing us real consternation in our businesses. And yes, to the extent they all have gold on balance sheets, to the extent they have gold, they're happy that they've made a profit in dollar terms or in dirham terms, but it's causing real problems in the business.
Yeah. I think you have highlighted a real difference in terms of how Eastern and Western people are looking at what's going on with the prices right now. And I think that's a topic that we've gone over in the past as well. So really interesting. And maybe talking a little bit more about those Western attitudes toward what's going on with the precious metals. I think the questions that I'm seeing a lot of right now when it comes to gold and silver is, all right, we went up to these all-time high prices. We've pulled back from there, although of course levels are historically high still. But people are looking and they're wondering, all right, when is the next leg higher going to be for gold and silver, and what is going to drive that? So any comments you could share on that topic?
Predicting the timing of these things is essentially impossible. Monetary Metals, we publish essentially fundamentals of the market as we measure it, and we've written all these papers as to why these are the fundamentals. But the fundamental doesn't tell you whether the move is going to be tomorrow morning or whether it's over the next 18 months. And there can be a correction along the way too. What we can say is that in gold, as the price has gone up, the fundamentals remain pretty flat, which actually is interesting because the historical pattern, the long dark period of second half of 2011 through 2018 into 2019, every time the price would go up, the fundamentals would get worse. And what was happening was the price was only going up because people, speculators in the futures market, who by the way use great leverage, were making big leverage bets on the price and driving the price up, trying to front run what they thought was, the rumor that the Bank of Ireland was going to buy, or this central bank or that central bank or whatever. And they end up front running only themselves. And then eventually when everyone's all in, they start to go for the exits and, the price comes down. And that happened over and over and over again. Price goes up, and with it, basis goes up. Okay, that was the pattern for a long time. And every time that happened, the gold bug community would write, that's it, this is the moonshot, and they'd have pictures of rockets on their articles and stuff. And I would always put out this little article saying, this isn't the moonshot you're looking for. Or I would quote Aragorn, the day will come when silver will be $50 and more, but today is not that day. I can't tell you how many times I overused that until that cliche was completely worn out between 2012 and 2018. And they called me a perma-bear. Keith hates gold. Keith works for the Fed, wants the Fed to win. And the guys didn't get it. So now we see rising price, and in gold, the fundamentals are not softening. Now they're not firming up either, but they're not softening, which, given that the price has now been picking up again, is notable. Now in silver, the fundamentals are actually getting firmer as the price is going up. And so now we're not in the territory that we're in October, by any means, but which was a crazy one-off, once-in-a-lifetime event. But fundamentals are getting stronger even as the price has gone up. Now, does that mean that you'll see $60 silver by end of year? That's a mug's game that I don't want to play. But there's a generally rising price trend. It's a trend. It's a mega trend, right? This is global. This is a durable trend. And, will there be corrections along the way? Yes. Will the price trend higher? Yes. What's going to happen in what order, to what degree? The market's going to unfold. But if you want to make a bet on silver and don't get crazy with leverage, you could argue there are plenty of worse times for doing it than now. And why? Because the monetary system is turning to bleep.
Well, that's also quite interesting to look at. So going forward, I know you don't want to make too many price predictions here, but is silver looking like the better bet versus gold as we are heading into 2026?
Yeah, silver's always been, it's much more volatile than gold. So, when the market's going down, you're going to lose more dollars in silver. When the market's going up, you're going to make more dollars in silver. Right now, yeah, I think a better, if you're going to bet on one or the other, and I don't think you're going to go wrong with either. It's like picking stocks in a bull market. You're throwing darts at the board. As long as you hit the board, as long as you don't somehow poke your own eye out, you're going to do okay given enough time. And I think we're just in that kind of market right now. And I can say that institutional investors, so when we started monetary metals in 2012, we were selling a niche hedge fund to trade the gold-silver ratio. But the thing that was unique about it, we kept the books in gold, and the compensation to us as the managers of the fund was based on how many ounces we gained, not the dollar price gain. Little did we know that was, a hell of a bear market that was going to last for years and years. But maybe one of the indications that we should have picked up on was institutional investors, of which we spoke to many in 2013, were all trying to exit whatever gold positions they had, and most of them were the ones that we spoke to at least had a gold position. They were all basically saying, "Oh yeah, we're exiting our position. We're getting quarterly liquidity, and next January is the last tranche. We'll be able to be paid out and cashed out and close our position and move on." So everyone was exiting. Now everyone is entering. And I don't think they've largely, some of them have entered, of course, but I think many of them have not entered yet, and they're trying to pick their positions. And we see institutional investors who largely have avoided gold. They have an allergy to it, trying to figure out their, gold strategy, as well as family offices and others. And so with that uptick, you can see, okay, there's going to be relentless buying, which of course will be a self-fulfilling prophecy to drive the price up. So I think we're in that mode at the moment. Throw some darts at the board. Yes. Don't get crazy with leverage, because, if you're using leverage and the price moves against you, you get wiped out. And then the price will turn around and go even higher, but you're out because, your position was zeroed out. So don't let that happen to you.
Well, and speaking about these institutions coming into the gold market, they want to be involved. I've been seeing a lot of headlines this past week or so about Tether, the stablecoin issuer, being the biggest buyer of gold in the third quarter, ahead of even the central banks that were buying in Q3. So I'm wondering if you've been hearing about that, if that's on your radar, and what it could tell us about the gold market right now.
Well, first of all, isn't it interesting that native sons of the crypto world are buying massive amounts of gold, analog Bitcoin, if you want to call it that. They're not loading up on more crypto or more Bitcoin. They're loading up on gold. Isn't that interesting? And they're pretty open to talking about it, why they believe in gold and all these things. And I'm like, yeah, it has these characteristics. Tether is also, I don't know if we talked about this the last time I was on your show. I know I've talked about this with somebody. They're trying to do more interesting things, right? It's not just buy gold. That's the retail play. If you think gold's going to go up, you buy gold and you stick it under the pillow, right? So in Turkey, they actually have a term that translates as pillow gold. Um, in India, they have a different term for it. Obviously, in North America, we'd say under the mattress. That's a retail, or stick it in a brings wealth. That's kind of a retail, mindset. Institutional investors are like, how do I get this working for me? And it could be, okay, we buy all this gold, we stick it at a bank like HSBC or JP Morgan, and we get credit against the gold, which is what we call a Lombard loan. You pledge your gold as collateral, you get dollars, and then you can invest those dollars in whatever you want, whether it be Nvidia stock, whether it be, old whiskeys that are aging, whether it be real estate, antique Ferraris, Picassos, whatever you want. And if your thesis pays off, the price of gold goes up and the thing that you bought goes up, and the interest you pay is a small cost relative to the two big capital gains you've had. And so there's a lot of, family offices and others that would take that approach. Tether is building or has built, I'm not exactly sure what stage of the process they are, a gold desk similar to what either a bank would have or what a commodities trading firm would have. And they're doing investments in streaming and royalty companies. They're buying pieces of mining companies, doing all kinds. They're buying equity. They're buying streams. They're doing all kinds of stuff to, and I think they're doing arbitrage, right? So it's buy spot, sell forward. They're doing all the things to play in the gold market and generate returns, which is, it's more of an institutional approach versus retail approach, and you're getting more out of the gold. So, I have to cheer that on and say that's great. People are becoming more sophisticated. They're questing for that word, yield, that Monetary Metals talks about and evangelizes all the time. And that's what everybody is, sort of questing for blindly is, we need yield, right? If this is money, if gold is money, that's the thesis, right? Then money should generate a yield. You should be able to find something to put it into that generates a yield. And we'll see Tether, where they go. I can't speak to any particular company and what they may or may not do, but in general, I think the market at the institutional end, that's what they're, that's what, and it can be blind and sort of groping, but that's what the market is seeking.
I think that makes a lot of sense how you explain it, and there is a lot more going on there with Tether than just the buying of gold. And I also think it's worth noting. So we're seeing this ongoing interest in gold, growing interest in gold, and currently right now we are seeing the Bitcoin price really take a hit. So I wondered if you could share any insight on what you see going on there and how that could continue to play out.
So, the Bitcoin, there's a term that the Australians use, which is spruiker or spruikers. And a spruiker is like kind of a cheap promoter, carnival barker that will say anything to get you to buy or whatever the behavior is they want out of you. So the Bitcoin spruikers make a bunch of promises and it sort of goes around in a circle. So they make a promise and then you sort of explore that. It turns out not to really be true. And then they just move on and it comes in a circle. And one of their big ones is digital gold. Well, first of all, that's one promise they make about it. No, it's not anything like gold. It's more like digital NASDAQ, with extra juice. It's like a high beta version of NASDAQ. And then they talk about store of value. I don't really think store of value is a legitimate concept, but for a lay audience, people sort of get like, okay, if I hold this thing, I hold my value and I come back to market 20 years later, I leave it to my grandkids, I want them to be 35 years old before they're eligible to inherit, so they don't turn into, playboys and waste all their money. They have to get a real job and a real career, and then they inherit it, when they're 35 or 40. So decades hence, they're going to get the gold. Regardless of whether that concept is really a right concept or not, everyone kind of understands that gold 50 years from now will still be highly valuable. And, the price can be plus or minus whatever, but it certainly, if there's monetary debasement, the gold price more than adjusts for it. if consumer prices go up, not necessarily so, because consumer prices may go up for other non-monetary reasons. But if the money's going down, then the price of gold, goes up as the inverse to that. So the Bitcoiners try to capitalize on this understanding and say, well, Bitcoin does this too. And so when you see a massive drawdown of 36%, I think, so far, we'll see if it's over. They're very highly confident it's over. We're back to the races again. But then they were highly confident when we had 126,000. It was on its way to 1 million. None of them predicted, 80,000. So, we'll see. But anyways, people kind of get discouraged and they start to think, well, Bitcoin isn't a store of value. Look at the gigantic drawdown that just occurred. And so some of them exit, never to return. And even the ones who, want to return, they start to see it more as a trade. It's volatile, and if you can catch the timing right, boy, can you make a lot of money. Trading vehicle, wonderful. Where do you turn when you want to take out some of your winnings and hold them as something stable? It ain't Bitcoin. And if it ain't Bitcoin, it ain't any of the other crypto coins. But what is it? They don't like fiat currency, and I don't blame them. That only leaves one 4-letter word that begins with G and ends in D. And so there they are. Maybe they buy some silver too, I don't know, but basically gold.
Yeah, I can see how that transition could start to play out. And just continuing on a little bit further into what's going on in gold and silver right now, I find that you're always really good at pointing out misconceptions in the market, things that people might be missing. So I wanted to ask, I know it's a little bit of a broad question, but is there anything you're seeing on that note right now that you think investors could be missing that they should be aware of?
Maybe the biggest thing is when people talk about dollar weakness, and what they mean is the dollar index. Now, the dollar index is heavily weighted to the euro. So it's a measure of the euro, it's a measure of the dollar in euro terms, with some, yes, there's a pound and a yen and a yuan in there, but it's majority euro. So they say the dollar is going down or whatever. First of all, it's not really true. The dollar index, I checked a couple of days ago, I don't follow it every day, was basically 100. So, it's a cycle that goes up and down anyway, and de-dollarization is not a thing. Every once in a while I like to, actually, so there's two things. One is de-dollarization. Boy, is that a giant mistake. And every time, people are talking about this, my headlines, just scroll, whether I'm looking at Yahoo Finance or wherever I'm looking. And, there was some here in UAE, I don't remember if it was a sovereign fund or a big private developer, just issued some $50 billion bond. Now, the dollar is not the currency in UAE. The currency in the UAE is dirham. And they're issuing $50 billion bond. It's not de-dollarizing, not in the remotest, sense. And then once you borrow that $50 billion, then you have to service the debt. So the demand for dollars is ferocious and relentless. So that's one misconception. Another misconception is if the dollar is going down against the other currencies, the dollar index is 100. That's definitely not the case. And then the third is trying to measure, saying the dollar is going down because the euro is going up. You can't measure the dollar in euros. The euro is a dollar derivative. So I like to use the analogy of if the underlying thing is Apple shares, and then you have Apple call options. So you have a December call option with a strike 5% above the market. That's the derivative. You would never say that Apple shares went down in terms of Apple call options. You would say the Apple call options went up. But in the case of the dollar, we do that. We say the dollar went down when the euro went up. Okay, the euro went up. That's nice. And there's a million, monetary system reasons why the euro can go up or down. You can't think of the dollar in terms of the euro. So to say the dollar is going down, therefore gold is going up, it's just a non sequitur, right? So measure the dollar in gold, measure the euro in dollars. And if you do that, it's so much simpler, so much cleaner. It's like before Copernicus, I thought they were trying to figure out where everything was moving around the earth. and you get the retrograde motion, which is too complicated to even describe mathematically, let alone explain the cause of that. When you realize everything's going around the sun, it's so much simpler. And it's the same thing here. Think of the dollar as being valued in gold. And the price of the dollar is, whatever it is, less than 8 milligrams of gold. And then think of the euro as priced in dollars. The euro is $1.14 or whatever. And it's so much easier rather than thinking of the dollar index. So no, we're not de-dollarizing. No, the dollar is not going up or down when the euro goes down or up. And no, the euro going up does not mean the gold has to go up necessarily. Maybe sometimes, but sometimes the opposite. And, the dollar is going down because the system is going off the rails. The system, that was the euphemism, floating currencies. So Milton Friedman said, the currencies are floating. It sounds wonderful, right? No, they're all sinking in the same way that if you had a cargo jet and you open the cargo door and you have a brick going down and you have a rock, maybe you have a bottle full of beer, maybe you have a bomb with, fins on it, you have a 2x4, you have all these things falling out of the plane. And then, if you put GoPro cameras on each one of them, if you had a camera on the brick, the 2x4 and the bottle of beer would look like they're going up, at least in the period of time that it takes for them all to fall. Eventually they'll crash into the earth and they're all destroyed, right? And maybe the bomb blows up and, it spreads the glass shards everywhere, whatever. But, it's not really going up, is it? That bottle that's in free fall out of the airplane. It's not quite free fall. It has more air friction relative to its mass than the brick. So the brick is falling faster. And so from the brick's perspective, the bottle is going up. But if you got a camera on the bottle, the brick is going down. Meanwhile, if you got a camera on the ground, they're all going down at different rates. And Milton Friedman used the term floating, but actually they're sinking or even free falling, or even rocket propelled down. So what a terrible analogy and, euphemism. And that's why I use airbag. It's a euphemism.
Yeah. You can see how you really need to reframe your thinking around the dollar, gold, other currencies in order to understand that. So thank you for going into that. And I want to pick up on some topics that we covered in our last conversation, which was back during August, I believe. We're talking about the Fed at that time, and you had said interest rates were going to start coming down probably sooner rather than later. And we've seen that start to unfold. Of course, inflation remains above the Fed's 2% target. And looking forward to the December meeting, I know there's some questions about whether we'll get another cut there. So I wanted to get your take, see what you're seeing from the Fed looking forward to next month and also into next year.
I mean, my view is the same. They have to cut rates. The trend is down. And now I have a little rant. I don't know if I've made this rant in conversation with you on your show yet. I know I've done it elsewhere, but the rant is that if all you cared about was consumer prices, what we call inflation, the consumer price index, if that was your only concern and you were willing to ignore the many, many grievous harms that would be caused by this policy or the strategy, you should want lower interest rates, not higher interest rates. Yes, I am saying the entire world of mainstream economics and alternative economics, which they all agree that if you want to kill inflation, have higher interest rates. I'm saying, yes, they're all wrong. If you want lower consumer prices, you should have falling interest rates, which will, by the way, inflict grievous harm in a number of ways on the economy. I'm not recommending this as a policy, but if your focus was this narrow thing of consumer price index inflation, you should want lower interest rates. So I'm not saying that they're going to have lower interest rates despite the inflation that's too high and that somehow they're going to juggle the goal of lower interest rates and neglect the goal of consumer prices. They're actually tied. And this has been understood since Knut Wicksell studied this in the 1890s. Now, he was a monetarist, and he studied the quantity of money and the price level, expecting to find they were correlated. That was the expected result, but he was honest enough to record what he actually found. what he found was they're not correlated. Instead, what he found is the interest rate is correlated to the price level. Later, an economist named Gibson was talking about this, and this was dubbed Gibson's paradox. It's only a paradox if you expect the mainstream theory to be right, which it isn't. And so this Gibson's paradox has been understood since, I think, the 1920s, about 100 years ago. It's not new. And then monetary theory has discarded this and pretend it's not there. It's an anomaly that doesn't fit, so they just bury it under the lump under the rug and, move on. But anyway, this was understood. Now, they didn't understand why, but they understood it. They at least recognized it. And the answer why is very simple. A falling interest rate is an increased subsidy to producers to borrow more to produce more, right? So if you are manufacturing burgers, you're a burger restaurant, and the interest rate ticks down, that is your incentive to open up another store. And unless the appetite for burgers increases, or unless the population increases, that is going to push the price of burgers. The price of burgers will at least be soft, if not falling. And conversely, if you raise the interest rate, then any number of burger restaurants are rendered submarginal, that they can no longer service the debt and have to be closed and go out of business. When they are closed and go out of business, the remaining, which is a fewer number of burger places, there's a reduced supply. What happens when the supply goes down? Well, the price goes up. And so this is not that complicated, and the mainstream theory has it backwards. So if you want lower prices, you should want falling interest rates. And I think we're getting them because the business can't afford the interest rates that it's paying. The whole thing is unsustainable. We're on a falling trend for many decades for reasons that go way out of the scope of this interview. But I think that's going to continue. And also, Trump wants lower interest rates, and he apparently has the power to force it. So Powell's going to retire soon, or his term is up, and Trump's going to replace him with somebody who absolutely will go for lower rates and will have lower rates. And you have it. Now, meanwhile, consumer prices are rising and high because of a number of non-monetary forces, including tariffs. So I'm told that in Canada, you can't buy American wine, beer, or whiskey anymore. Right, so the remaining brands, which are either European or Canadian, have the leeway to raise their prices. That's not monetary, right? That's a result of fiscal policy, a tax. In the U.S., you slap a 20% tariff on, imported cars, and then you find the price of cars goes up 20%. And the domestic manufacturers can take shelter underneath that. Then maybe they don't raise their prices 20%, they raise them 19%, 18%. But prices go up. And then people say, well, we have inflation. We need to have higher interest rates. Higher interest rate would mean a higher cost of capital for anybody wanting to finance the construction of domestic capacity. If you're a domestic automaker and you say, well, they've taxed Mercedes and Jaguar and everybody out of the market, I want to open a plant to manufacture more cars. Well, they've just jacked up your finance costs. And so the business case is retreating out of sight, even though the price of cars is going up. Very perverse.
Well, I appreciate the rant. And I wonder, so if we put all of this together, I know people looking into the new year have a lot of questions about how the U.S. economy is going to be shaping up. What do you see coming? What would your outlook be there?
Try to summarize this in one thing. It's almost irresistible force, immovable object. The world is not only not de-dollarizing, but dollarizing ferociously. So more capital coming into the dollar, more desire to invest in the U.S., because if you invest in other countries, even if your thesis turns out to be correct and the economy is doing okay in that country, which, by the way, stronger dollars hurts a lot of other countries' economies in a myriad of ways. But even if you're right and the currency goes down, in absolute terms, it may actually be going down. So investment wants to come into the U.S. Businesses that are forced not to be able to be in business in their local places. Suppose you have an energy-intensive manufacturing business in Germany, and they have this policy that I'm going to botch the German pronunciation, but I'll try, Energiewende, which is their energy transition to get rid of all the energy sources that work and replace them with all the energy sources that are unreliable or don't work. So get rid of, coal, natural gas, nuclear, and replace it with wind and solar. Solar, by the way, in a place so far north, I can't imagine that the sun is particularly strong in Germany. It's pretty far north. But yeah, they're doing that. So if you're an energy intensive industry, you want to open a plant in the US when the energy is a hell of a lot cheaper. But at the same time, you have trends where, if immigrations and customs enforcement isn't arresting your trainers that are trying to train the American workforce as they did to Hyundai, if you're not getting, your raw materials tariffed, out of reach, then your workforce, the workforce you'd be hiring are being deported. Where are all the workers going to come from? It's not like there's 50 million American workers that want relatively low wage, assembly jobs. The workforce isn't there. I think it was Tim Cook at Apple. Was it the first Trump administration who was talking about, can you make iPhones in the U.S.? And he said, there's whole industries where you have, engineers that are like manufacturing engineers. So these are engineers that have figured out where to put the screws and what size threads to use and how to fit the circuit board into the enclosure. There's like all this engineering that goes around all this stuff. It's like that skill doesn't exist in the US, and in China they have like 10 million people that are experts at that. And then how many people do they have that are willing to sit at a table for 8 or 10 hours a day and screw little circuit boards into, little mobile phones? And, they have 50 million people that are willing to do that. And America doesn't. Americans don't want those jobs anyway, certainly not at those wages, but probably not at any price. And so on the one hand, it wants to come into the US because they're screwed even more in Europe. On the other hand, the US is doing all these things to, push them out. And, what's going to win? I don't know. Obviously, if you're a company that makes manufacturing automation tools, you're probably in a pretty good position. So that's an investment thesis. Anything that can reduce the labor is a good bet. Whether we technically hit recession or not, I don't have a strong, call on that. I can say that the economy will continue to grind harder for working people. None of this is good for working people. We're driving up costs. We're driving down returns. We're doing everything to drive down employment. None of this is good. But, that's the policies that are, populist, right?
Yeah, and I think we've talked before about that kind of bifurcation in the economy. And I saw a stat this week that really got me. It was something like the top 10% of earners in the US are now responsible for half of the spending. I don't know if I'm getting that exactly right, but something like that. And that's a historic high. So anything further you'd add there, is that just going to, for the working population, like you're talking about, does that just continue to worsen for them essentially?
Yeah, I think so. And then, of course, with that is social tensions. Real anger comes out of this, and people talk about inequality. Every every hot political issue to me seems like a false alternative. The one side is saying, let's use the government to unjustly and unfairly advantage a tiny little group. And the other side is saying, let's use the government to forcibly equalize everybody. So imagine you have a bunch of people that want to play basketball from me to LeBron James. Well, there's only one way to equalize me and LeBron James. I'm not going to be a great basketball player, but you could cause enough injuries to him, load him down with 100 pounds of cement to make him play no better than me. Tie one of his hands behind his back, blindfold one of his eyes with no depth perception, weigh him down, break his legs, whatever you do, right? And now we're equal. So on the one hand, it's like forced equalization, and on the other hand, incipient fascism. So the Dubai Precious Metals Conference was held. People may know that Dubai has these artificial islands, and making these artificial islands is a real art. Here in Dubai, so they have this. It's not really one island. I think it's actually technically multiple islands called the Palm, And so it sticks off the mainland, and there's the trunk of the palm, and there's the fronds, and then at the very outer tip of it, uh, it's a very high valued real estate, and there's an Atlantis hotel resort, which is the same people who do the Atlantis in Nassau, Bahamas, except this one is bigger, more high end, and I think an even bigger aquarium that you can get under, and the kids can get underneath it, look at the fish above them, and all that. And I think the biggest water park in the world with the slides and the endless looping pools with, there's a current that goes around, you get in your floating mattress and, inner tubes and whatever. And it's a very expensive, I don't know why the conference went there. I mean, it was $600-700 a room, per night. I mean, it's a very expensive place. And there's, it's a huge, huge hotel. The conference did not fill half of it. So there's all these tourists that are there, and everybody's walking around, all the ladies are walking around with Louis Vuitton or Gucci, bags that probably cost $1,000 or more. And they're sipping drinks that are $25. And, and some of them are suites and whatever that are $1,200 a night. And there's a certain class that's spending like there's no tomorrow. Now, a lot of this is spending on credit cards, all credit. But a lot of it is, these are the people that are trading, whether it's crypto, whether it's Nvidia, and they're taking down millions and spending it. But this is what Keynes talked about when he said, if you debauch the money, you destroy all sacred bonds between creditor and debtor, and generally impoverish most people, but arbitrarily and capriciously enrich a few. And those bourgeois that are arbitrarily enriched will be resented by their fellow bourgeois. This is all in Keynes, parlance. We're seeing that. And when the interest rate really begins falling again, that's going to drive asset prices up to a whole nother level. And the asset owning class, especially those that are privileged to have access to credit to buy assets on leverage or margin, will see huge leaps in their net worth, and they'll be driving around in Bugattis and Rolls Royces and all these things, and everyone else is simmering with more and more anger, demanding equality in the sense of Mao, struggle sessions, right? Tear everybody down, kill them, make everybody the same. You're not even allowed to wear different clothing. Everybody has to wear the same peasant smock, right? Or in Russia where, you send 20 million people to die in the gulag. And that's, anyway, we're headed towards a dark, I hate to be pessimistic about it, but we're headed towards a dark place with all this because it's unjust and it's unsustainable and it's going to break somehow. And, if we don't come to our senses and reverse these policies.
I think you encapsulated it very well there, and it does seem like it's going to be heading toward tough times. And I've got to get you out of here. I know you've been working really hard all week, but before I do, maybe we can end on your best advice for investors heading into 2026, given all that we are dealing with right now.
Well, I'm not normally sort of the stock picker, recommend this or recommend that. I think interest rates are coming down. So if you want to buy long-term treasuries, as ironic it is for me to say that, the gold guy saying bet on treasuries, and as perverse as it is, right? There's nothing good or healthy about treasury bonds as an asset class going up. But that's the theme. If you want to bet on the dollar against, peripheral currencies, I think that's likely to be a good bet. Not necessarily the euro, not necessarily a big move in the dollar index, but certain peripheral currencies, if you can find a way to bet on that thesis. I think the price of gold and silver continues to go higher. Ironically, at the beginning of the year, and I always joke about this because I write all the price prediction stuff for our annual gold market outlook report. I do the writing basically in January. And then there's a bunch of other things that come together in terms of content. And then there's all the graphic production that goes into it. And then it comes out in like late February, early March. So by the time it comes out, either my call is either completely rendered moot. People, he didn't stick his neck out at all. That's already happened. Or it goes against me and I look like an idiot. But, rather than a prediction, I'll just look I'm wrong. But, This year I said the prices of the metals will continue to trend higher, and we could see 3,600 in gold, and if that happens, $37 in silver. Obviously, we saw them. They're in the rearview mirror now. And so somebody could argue, Keith, you're wrong. Well, I said it was going to go up, and I said this is an imprecise art. They went up more than I predicted, but I have to do the analysis for the upcoming 2026 one. But I see all the trends are still intact. All the drivers are still intact, I should say, and therefore the trends are likely to continue. Higher prices for the metals. So if you're inclined, you can buy metals again. Don't get crazy with leverage. It's leverage that'll kill you. If you own it unleveraged, you're not going to get hurt. If you own it with leverage, you can be zeroed out.
I think that's good advice for us to end on, and hopefully next time we talk, we'll be able to look at the 2026 predictions, and hopefully you're looking right by the time we're seeing them. Thank you so much for coming on now to go over what's happening in gold and silver markets. This was great as always.
Thank you, Charlotte.
Of course, and once again, I'm Charlotte McLeod with investingnews.com, and this is Keith Weiner with Monetary Metals.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.